the class. Okay, all right. Okay, so what did we discuss in the last class? Towards the end of the last class? Does anyone remember? What were we discussing? I think if we look at session outlines, yeah, so we discussed these concepts. Please make sure you read up a little bit on Occam's razor. You should understand this principle. It's a very important principle. It comes into play in many aspects of life. Okay, WeWork, there are some further developments. The CEO has been kicked out. You've noticed that. SoftBank, all these things, and you learn when you watch all this stuff. You see SoftBank they had already put in $10 billion. So when you borrow a lot of money from someone, he is the one who is nervous, not you, because if you get into more trouble, he has to pump more money into you to keep you alive. So this is what happened with SoftBank. They pumped 10 billion into WeWork earlier. Now WeWork has gotten into trouble. Now they are pumping in another 10 billion. So the CEO is out. So there are all kinds of, when you watch all these stories, you should see all the corporate governance. You've heard about corporate governance?
Because they have to buy out the majority share from the CEO. There were some agreements.
Yeah. So he owned the shares. The guy called Newman, right? So he owned the shares, and so they had to buy him out because they wanted to take control of the company. But the main problem is they're already pumped in 10 billion, so that was too big a loss to take. So they're basically, what they're doing is they're doubling down. See, this is the same as when you buy something and it falls in value. Instead of cutting your losses, you're buying more, because the loss is so big you can't afford to take it, right? So they're doubling down. So watch all these things and think about all these aspects, corporate governance issues. And in this particular company, you guys have heard of governance, corporate governance? Yes. You're doing some courses on ethics and all that. So this is pretty big right now, corporate governance. And so this is actually a classic. So you should study the WeWork story a greater deal. You'll find lots of discussions on the Bloomberg Technology programs and other places. Study the WeWork case as a case. It's one of the worst cases of governance, because all kinds of shenanigans were going on. Related party transactions. You know what related party transactions are? Like if I'm the chairman of the board of a company and I'm giving some fat cat contracts to my brother, to my cousin, so this is not allowed. You can't have related party transactions. So there's a conflict of interest. So all these kinds of things, all this kind of shenanigans were going on in WeWork. So WeWork is a very good case of how not to govern a company. So do read up on that. This is how you build up your experience, right? And you connect it to, okay, so we discussed Vega versus, we discussed the meaning of eyeball in detail, and we looked at the changes in how the Vega is longer for, Vega is higher for longer dated options. So all these things we did yesterday, the previous day. Okay, so now we are looking at another topic, which is understanding that this is just not a strict relationship. This I've already written. This is not a law of physics, okay? When we use this expression, what we mean is that this is not always true. This is true pretty much of every relationship that you look at in finance, okay, and economics, is that you can't rely on this. There's only one law in economics which always works, which is that people respond to incentives. Okay, human beings respond to incentives. That's why socialism fails, because human beings are selfish and they always try to maximize their own benefit, and they always respond to incentives. If you give them incentives, they'll respond to it. So it's the only law of economics that always works, and the rest of the laws are not necessarily guaranteed to work all the time. Okay, so now the other topic we are looking at now is directional moves in the underlying asset versus directional moves in the eyeballs. Okay, we already know what the relationship there is. Okay, where is our... Right, so today we have changed the ticker a little bit just for fun. Did any big event happen from a governance perspective at Oracle recently, last 10 days or so? Yes, Shuchi said something. Not the owner of Oracle, the CEO of Oracle, the co-CEO of Oracle, Mark Hurd, who's one of the leading, one of the big well-known figures in technology sales. Okay, he's a big marketing guy. He was earlier with HP and all that. So Mark Hurd died at a very young age. He's 62 or something. So he died. The owner of Oracle is, well, not the owner now, is the ownership is dispersed. But who's the founder of Oracle? You're graduating as business students. So these are all iconic names. It's like you don't know who's the founder of Microsoft. If you don't know, if you don't know who's the founder of, it's like you don't know who's the founder of Apple and who's the founder of Microsoft. You don't know these. I'm sure that also who's the other guy along with Bill Gates who founded Microsoft? That also you don't know. Paul Allen. So Paul Allen passed away, okay, a few days back, okay. So anyway, so these things, go to YouTube and watch a movie called, it's a very nice movie. We were shown this movie in 1988 when I joined Ahmedabad in our first year. We were shown this movie, and it's still a nice movie, I think. It's called In Search of Excellence. I'm sure if you look at, I'm sure you can find the PDF also. It's by Tom Waters and Waterman, Tom Peters and Waterman or something like that. So a couple of guys from McKinsey wrote this book. It's a very well-known book in strategy. It's that old, okay? In 1988, it was already a well-known book. But there's a film as well. We were shown this movie, In Search of Excellence. So you can see all these, and those lessons I think are still valid. Okay. So these are all so founder of Oracle is Larry Ellison. Okay, so Larry Ellison is one of, for those who are going into sales, you saw that guy who came from Oracle in your HR conclave. Okay, so he's a sales guy. Oracle is well known as a very hard charging sales organization, the very effective sales team, because now they are struggling because they did not go into the cloud fast enough. They stuck with their on-site legacy software, licensed software, whereas the most of the market moved into cloud-based software. So you see companies like Salesforce. Have you heard of Salesforce? Yes. So Salesforce.com, they have done. Salesforce actually is founded by a guy who's an offshoot. He used to work at Oracle. So the guy called Mark Benioff, who is actually one of the early guys who was working at one of the early buddies of Ellison, who used to work at Oracle. Then he started his own company, Salesforce.com. Okay, so Salesforce's ticker is CRM. You know what CRM is? Customer relationship management. That's this kind of software they make. That's why their ticker is CRM. Okay, so Salesforce, if you look at the Salesforce chart versus the Oracle chart, okay, you'll see there's a big difference. Salesforce has outperformed significantly because the market has moved significantly to the cloud, and Oracle is actually late to the cloud. Okay, and in fact, recently there was one big event that happened. Amazon used to run their entire e-commerce business, okay, on the Oracle cloud, but now they have just shifted it onto their own cloud. So that's a big blow for Oracle. Okay, so all these things. So when you watch all these things, if you keep track of all this news, there's a continuous series of lessons coming to you from strategy, marketing, technology, finance, everything. So this is how you have to look at the world of business, because nothing comes in a silo that, okay, I'm now giving you only a finance problem. It doesn't work like that. Okay, so most of the time you get problems which are all mixed up, with different domains all mixed up together. So you have to watch. Unless you keep on monitoring business news continuously, your understanding of the business world will not develop in the way that it should, right? Because you're MBA, remember, you're MBA students. People expect from you certain things: good communication skills, familiar with office productivity software. Okay, then also being able to look at, most importantly, being able to take a strategic view, being able to look at a business from a strategic perspective, looking at all the different domains, the marketing aspect, the technology aspect, the finance aspect, okay, all these things, looking at the supply chain operations aspect, looking at it, being able to integrate all these aspects and look at a business like that. That's what people expect from MBA students, right? So these are, because remember, you're not a hardcore programmer. Okay, so therefore the skill set is different. So you have to make sure that you develop that skill set. Is this clear? Okay. A lot of non-finance lectures, but I think these things are important from time to time to be properly oriented.
Yes.
Okay, so we have Oracle now. We have the chart of Oracle. What was I saying? Why did I get into this long lecture? Okay. Yeah. So the next topic that we are actually going to discuss is this concept of the directional. What is the relationship between the directional moves in the underlying asset and the directional moves in the eyeball charts? Okay. So here you have an easy way for any of your symbols. You can just enter it. At least 2 years of data you'll get. Okay. You can see the relationship. You can see the blue mountain chart being the underlying asset. This is the Oracle stock price, and the red line being the eyeball. Okay, so you can see this. Now, what we say in the market is that generally we expect. Let's look at this chart. So I've given you this hyperlink. Okay, we can open. This is all in your notes. Okay, so let's look at this. Yeah, let's look at the point that they're trying to make. You can read all this. So what they're trying to say essentially is, this is, again, as I said, this is not a law of physics, but generally we expect this. The market expects something like this, that when the market drops, the eyeballs, when the underlying asset prices drop, the eyeballs will go up. And when the underlying asset price, sorry, what did I say? Yeah, when it drops, so the relationship is inverse. When the underlying asset price drops, the eyeballs are expected to go up. And when the underlying asset price rises, the eyeballs are expected to fall. Okay, so as I said, this is a very general kind of relationship. You can't rely on it. Okay, that if I put this much velocity on this particular body, it will move at this speed. You can't make this kind of mechanical calculation, but this is what we normally expect. Okay, and the theory behind that is this: that if you see here, we can look at certain cases where this is happening. Okay, what happened here? What is the talk? Why are people talking? What happened? Now we have to cut marks for Rajan and Garvit. Why is your bag hiding your face? Put the bag down. 1 minute. I haven't deducted marks for a long time. Not that I want to, but you are leaving me with no choice. Okay, what is today? Today is 25. Okay, what happened? More talking. No talking. I don't want to hear any talking. Anybody looking here and there, looking at. You have to look at me, and you have to be intently following what is going on in the class. Okay, guys. So now this is what we are. This is the relationship that we are talking about. As you can see here, as for instance, I'm just giving you one example. So obviously this is not a foolproof kind of example, but I'm just giving you some examples here. You can see as the market falls here, as the underlying asset falls in value, the eyeball rises very sharply. Can you see that?
Yes, sir.
Okay. And if you also look at the numbers that these guys have crunched, this is from the SIBO website. Okay, this, as I told you, is a very good website, very reliable website. You can study from here. Okay, anything that is here is going to be reliable. Okay, all right. Now you can see here, look at this. So when the S&P is up and the VIX is down, okay, this is what they're finding out here. Okay, so this inverse relationship that they're finding. So this is what they're trying to document, that when the stock index goes up, the VIX tends to fall. The VIX is basically the vol index for the S&P 500. Okay, you know that we have the India VIX as well. So VIX is a trademark. Okay, so VIX is trademark. I guess Standard & Poor's or somebody, I don't know who owns the trademark, but it's one of these companies like S&P. So they have licensed this trademark to the NSE. Okay, and the NSE is now publishing the India VIX index. You can chart the India VIX here as well. If you go here, I hope everybody has a subscription by now. Okay, you can actually chart the India VIX here also if you want to examine. So the India VIX is meant to be related to the Nifty 50. I think this India confuses the system. Oh, oh, okay. How did this happen? I forgot to even. I forgot to even connect to. And today there's no. There seems to be no. Where's the test? See, I didn't even connect to the. Okay, there we have test. that's why. All right. So anyway, so VIX. So is this clear?
Yes, sir.
VIX is an index of eyeballs. Okay. So the original VIX was meant to be still there today. That's giving you the eyeballs for the S&P 500 index, and I've given you the SPY ticker to trade. SPY is just 1/10 of the S&P 500 index. Okay, you can see it here. Normally, some of you will get the S&P as the SPX as an index, but this is basically 1/10. Okay, so you'll see that the S&P is 10 times, the S&P 500 index is 10 times this size, 10 times this figure. Okay, so the SPY, for all practical purposes, when you're wondering about the VIX chart, the eyeball chart for the SPY ticker, okay, you basically just look at the VIX. All right, so which is what I've done here. I've given you, in fact, if you look at your I think maybe we have to do it again. Yeah, so here you see you can get India VIX as well. All right, and you can get, this is the SIBO Vol Index. All right, so this is the VIX. As you can see, the VIX gives you the eyeball chart for the S&P 500 index, for the options on the S&P 500 index. And so for all practical purposes, your SPY ticker, which tracks this index, you can use the VIX charts. You'll get lots of long-term data for that. So, and be aware that India VIX is also available for comparing it to the Nifty 50 index. Okay, so this is a case of licensing. Once again, you see your intellectual property laws, you should be able to connect it. Okay, that there is a legal aspect involved here when you're licensing an index. All right, so we're going back to our relationship here. All right, so this is an inverse relationship. So I'll just briefly explain to you. Has everyone understood this? That this is what we normally expect. Okay, so now the logic for this is, it's really sort of derived from the stock markets. The logic for this is typically that most stock market investors are net long. Okay, the most stock market investors are net long. Okay, and therefore when the market starts to drop, they start losing money, right? And what they do is, in response to their them losing money, what they do is they try to buy put options as insurance. Okay, right, something like along the lines of what Garvit was suggesting a couple of sessions ago, if you remember, but not exactly this, but something similar. He was trying to protect the risk on his position, right? So basically understand this stepwise. What is the logic for this? You should be able to understand this. Don't just mechanically memorize that there's an inverse relationship. What is the origin for this theory? The origin for this theory is that that stock investors normally are net long. Okay, they trade from the long side. They don't have a long short bias. They typically trade only long only. All right, and so they're long only. And so when the market starts to drop, that's the underlying asset price starts to drop. We can so with the underlying asset price starts, we can look at this part only, just to, although the relationship is not great, we'll just look at this part just to make a case. All right, so when the market starts to drop, what happens is the long only investors, they start to lose money on their positions. Are you following? Right? Then they want to buy some insurance to protect their positions. Okay, and then they go out and start buying put options. Okay, and then buying, as that pushes, what happens when there's an excess demand for put options? What will happen to the price of put options? Fall, rise. Okay, and prices of options rising means what happens to the eyeball chart? Somebody said decrease. Up, right? Not down. Up. Yes, Survi, you're convinced? Because eyeballs are an index of option prices. So if option prices are going up, means when you look at the eyeball chart will go up. Okay, and remember this, you haven't done this relationship yet, but there's a relationship between put and call prices through the relationship of put call parity. So when put prices go up, call prices will also be pulled up. Okay, because of that no arbitrage relationship, okay, between calls and puts. So this is basically what happens. This is the logic behind this theory. There's a theory that, as you can see, they have also empirically documented. This is what they have empirically documented, okay, for a particular period. But again, remember this, that this I'll just come back to this. Okay, so the theory, when I first understand the theory, why is there an inverse relationship? Because stock investors are net long. When the market starts to drop, they're losing money. So what they try to do is they try to cover their losses by buying put options as insurance. Is everyone clear why, if you are net long, if your underlying asset position is long on stocks, okay, long on equities, then when the equity market starts to drop, the kind of insurance that you're going to buy if you're buying options is going to be buying put options. Is everyone clear about that? Okay, that you're not going to buy call options, right? So you buy put options, and then that pushes up the price of put options, which essentially means that the put option eyeball goes up, okay, and then the call option prices also go up, so the eyeball index goes up, right? Okay, is this clear? All right, so this is the logic. Now I'll just mention one more thing very briefly, which is we should mention. I think it's a very important point which many people don't emphasize, even serious academic discussions also, we don't emphasize this. Now let's use this chart, okay, to understand certain things about the empirical analysis in economics and finance and in social sciences generally, okay. As you know, you guys have followed this recent Nobel Prize award that has been given to this guy Abhijit Banerjee and Esther Duflo and all. So they have brought a lot of empirical analysis to economics, okay, and they have tried to analyze social problems and socio-economic phenomena through empirical analysis, okay. But understand one thing about empirical analysis. The problem with empirical analysis is that, especially in fields, can everyone read the numbers? Mehak, can you read the numbers? Now? Now? Now?
No, the thing is it's light.
Huh?
Colors in the graph are light. On the axis.
No, don't worry about the colors on the graph. I'm talking about this. Okay, let's just understand this. Okay, just note this. I'm not even going to look at the chart. Can you see the periods on top here? 7, 2, 12.
No, that's what I'm saying with the axis color on that.
Okay, never mind. Okay, let me just make this point from just a very important point. Okay, that understand this. We can just take this. What have these guys done? They have taken this period. I'll read out the numbers for you. Okay, this is 7 to 12, which means 2nd July 2012. Okay, 2nd July 2012 to 25th September 2012. It's a very short period. Okay, they have used, and you can also look at this. You can also look at this, and you can see how, to what extent the like this particular sharp rise and eyeball fall comes around this sharp fall in the stock price. Okay, here again there's a sharp fall in the stock price, there's a rise in eyeball. Okay, now what these guys have done is, let's just look at this relationship from July 2012 to September 2012. They have done this analysis. Okay, and in this period they have found that this 80% of the time when the S&P is up, the VIX is down. Okay, 82%. And then when the S&P is down, the VIX is up 78%. Okay, can you read these numbers at least? You can read, Sylvie? Last bench, yeah. Okay, so this is what they have found for this period. Okay, from July to September. Now the point I want to emphasize, actually it should be quite obvious, but I think sometimes because you are new to the whole subject and the whole method of analysis. Okay, so the point to understand here is, okay, that this finding, this 82%, okay, this 82% and 78% is necessarily true only for this period. Okay, if you have already seen a flavor of this when you guys did your beta calculations. Remember, you've done lots of beta calculations. Yes, nodding is not aggressive enough. Okay, now Anjum and Galati also are involved in some major calculations. I think they're calculating eyeballs. They're calculating eyeballs. Okay, so we can add them numbers also. Special mention. Okay. All right. Okay, so here, very important lesson. Please make sure you understand this. You're already familiar with this. You did beta calculations, and you must have done more than one beta calculation for one company, right? Do you remember that if you change the look back period? Okay, so if I'm doing Oracle beta, if I'm calculating the beta of Oracle, if I calculate it from today looking back 1 year, if I take that as my historical data, that is, I get some number. Let's say I get 1. Okay, but if I take from today to looking back 3 years, Will I necessarily get 1? I'll probably get some other number, right? So therein lies a lesson, a very important lesson for you, that whatever, so I think it's very important to emphasize this because I'm very concerned about students getting, losing sight of all these aspects, okay? That don't take, these are nothing, there's nothing golden about these numbers, 82.5, 82 and let's say 82 and 78. These numbers apply only to this period, 2nd July to 25th September of 2012, okay? If you take any other period, these numbers may not remain the same. So you can't basically, I mean, what I'm trying to say is that if you design a trading system based on this data, of course, normally you use much more data, but if you use a trading system and you assume that 82% of the time in the future also this will happen, this relationship will hold, that is not true. Are you able to follow? I mean, maybe it's very simple thing, very obvious. Is it obvious or what? Nobody is responding. Half the class, most people, I don't know, some people are looking down, some are looking. I need to get a response. Yes, no. Yes. So get that. What is the problem? It's the second class. You need some coffee. Everybody is half dead. I need to get good responses so that I can. Tata coffee is good. Let's see. Okay. Yeah, well, we don't have. See, coffee futures. Can you see the volatility? This is cents per pound. NYMEX coffee. Can you see the, this is dollars per pound actually. Can you see the volatility in coffee prices? Commodity prices are very volatile, okay? So can you see what is happening in coffee prices? Look at the movement from 2012, 2011, from a high of $3, it's gone below $1. Okay, just think about what is happening to coffee farmers. Okay, so this is good for Nescafe or bad for Nescafe? Good for Nescafe, very good. But very bad for coffee farmers. We grow coffee here also in India, South India we grow coffee. Vietnam is one of the big coffee, yeah? Okay. Yeah, so we won't have coffee, we'll have copper, crude oil and gold. Okay, all right, but I just wanted to show you this and hopefully this will wake up some people who are falling asleep. Okay, coffee futures. Okay, all right, okay, so let's go back to this. So just an important lesson here, just make sure that everybody understands. Okay, please look up. Garvit, what is happening? Look up. We'll have to have these some kind of a clip mechanism for somebody, the head should be always pulled up like this, like a lamp or something like that. Okay, so okay, so when you get this kind of an empirical calculation of a relationship, this is necessarily true only for that period. If you take a different period, this relationship need not hold. So don't become enamored of this, that oh my god, there's a 82% relationship, 82% of the time this relationship works, so I can design a trading system based on this. So I just want you to be careful that these kinds of this is true in this is not true in the hard sciences. In the hard sciences you can rely on it because the items that you're measuring are stable. Okay, but in marketing, because you're dealing with consumer behavior, okay, you're in economics, in finance, all these cases you're essentially dealing with the same kind of problem. Erratic human expectations, human behavior, okay, which is not stable, okay, not reliable. So therefore be aware of this problem. Is everyone clear about what I'm trying to say here? Okay, just a lesson. I mean, I'm not going to ask you in the exam that what is this, but these are things, some of the most important learnings are actually not things which I can ask you in the exam. Okay, that's why I say that exams are not really a big thing. But if we are giving you degrees, then you need to have exams. If you're happy to give up the degree, then I won't give you exams. Okay, so it's a great system actually. No attendance, no exams, no grades, but placement.
Yes.
No, but 1 minute. 1 minute. No company will hire you because you have no more crutches. It's much worse for you. Now you have no crutches. You can't point to your grades. You can't point to this whatever I got A+. The company will only evaluate you based on your knowledge. Yes? Intense interviews, right? Companies will gauge you based on their knowledge, on your knowledge, and your knowledge comes out in your body language. Your confidence comes out in your body language, and confidence comes from hard work. WhatsApp will not give you confidence. Okay, so remember all this. Now I don't know why I keep getting lost in how did I even get here. I don't know.
So this actually happens. This has actually happened. There was a guy who worked at Ashoka University, and Ashoka University was founded in this way.
Okay, in which way?
So
Okay, we'll do it later. We'll do it later. Okay. No, I don't want to discourage him from making a point. Give him a mic. Let him make a point. The whole point of coming to class is being able to make your points and ask your questions.
that guy went to a village for a marketing.
1 minute, guys. Please be quiet. Be quiet. Now make your point.
That guy went to a village for a marketing activity, and he observed
Mic.
hundreds of kids around there.
Again, you're putting the mic through the mic.
So he
Voice.
observed hundreds of kids there who were without job, without any skill. So what he did, he went back to
Mike.
the boss and convinced him that can we train these kids without any degree? We will just train them in skills, and if we found them that the skill we want them to acquire is successful, we will provide them a job.
Okay.
And after 5 years of experiment, 100% of the kids were skilled in a manner which was more than required.
So they all joined Ashok Leyland.
All of them.
Okay. Yeah, in fact, very good. So in fact, the same thing is happening in the US now, because in the US there's a tremendous labor shortage because of how hot the economy is. So the same thing is happening. One of the things that the Trump administration is doing, they're launching corporate partnerships. They're tying up with, like, Google is one example. Google is actually training 100 school kids. Okay, school or high school, college, high school kids, not college. Okay, high school kids, and they've taken them into an internship program, and if they clear the internal Google tests, they will be hired into Google. Okay, so the same thing is happening. As you can see, actually this is really happening in the corporate world. Facebook, I told you, Sheryl Sandberg very famously said, we don't care about, she herself an MBA from Harvard, but she said you don't need an MBA in the tech world, and she said that we don't care about what degree you have, we care about what you can do. Alright, so this is already happening. Facebook, Google, you know what they do? They have these sport coding championships. Sport coding is basically programming. Okay, there's a Russian guy who's won this for the last 3-4 years. So they have these sport coding championships, and Google and Facebook are going there and offering them like $250,000 salaries to the top ranked players, top ranked coders. Okay, so you don't get from class 10 or class 12. If you're a top notch coder, you can go straight into one of these tech companies at a very high salary. Okay, so basically what's happening is this traditional model of education, which in our country we have completely destroyed because we have totally mismanaged it. So everything, education has to always be about knowledge. It's not just when postgraduate, when you're going for your company jobs. From the beginning of your learning, from small kids, education has to be about knowledge and being productive. But that's not happened. Even in the US, in many colleges, they're not really learning any skills. So that you should also understand that thing is changing. The corporate world is now basically bypassing the higher education establishment in many ways. So this is also something that you should be aware of. Okay. So anyway, lots of long lectures which have nothing to do with finance, but still these I think are important for you to be aware of. Okay. All right. So next topic. So this, you understand that this is not a law of physics, okay? But just be aware of this, and that's why we have given you this what people look at usually to illustrate this point is the relationship between the SPX. SPX is nothing but the S&P 500 index and the VIX index, okay? Everyone clear? Any questions? No questions? May I look up? Clip. I need somebody invent some kind of a machine, where certain people, we will just put them like this. The neck will be always upright. It will not be able to go down. Okay. So, all right. Relationship. Okay. This is not a law of physics. Remember that. Okay. Next point. Next topic. Option payoff profiles and option profit profiles. Okay, so understand this basic difference in the terminology, because when you're buying an option, you are paying a premium. Who was talking to me the other day about I was giving the example of car insurance. Was it Garvit or somebody? After the class you were discussing? Yeah. So always remember, if you ever get confused about option premiums and things like that, always go back to your car insurance example. The car insurance company is the option seller. Okay, they are collecting premium from you because when you buy car insurance, you have to pay out premiums first to the car insurance company, and then if something happens to your car, then you can go and make a claim. Okay, so your making a claim is just like the equivalent of exercising the option. You understand that? Yes? Everybody?
Yes, sir.
So when you make a claim, it's the equivalent of somebody exercising the option. But the option seller has already collected the premium upfront. Usually they collect the premium upfront. Sometimes you can rearrange it using those annuity formulas. So the same thing that you are, instead of collecting it upfront, you take the same thing, so you convert it into an annuity so that both of them have the same present value. Okay, so you can structure it that way if you want, but usually the premium is paid upfront. Okay, so the option seller, the car insurance company, it collects the premium upfront and then hopes that nothing happens to your car, so you don't file a claim. Okay, so is this clear? Okay, so if you ever forget about option premiums, who's taking money, who's losing, who's paying out money, who's receiving money, just go back to your car insurance company example. Okay, the insurance companies are option sellers. All right. Okay, now let's look at payoff and profit profiles. Okay, this is there in your figure 10.1. So let's look at figure 10.1. Please make sure you're doing your readings, the readings that I've given to you in the notes. Okay. Okay, 10 point, yeah. What have I said here? 10.1 to 10.5. So let's go to 10.1. So have you understood this? Be careful, don't use words in the wrong way. When you mean payoff, don't say profit. They're not the same thing. Okay? So the profit is payoff adjusted by premium. Okay? So whatever your profit will always be less than the premium. Okay? Sorry, less than the payoff. Okay? If you're an option buyer, you'll be less than, because you've already, whatever payoff you get, from that you have to subtract the cost of the premium to find out your net profit. Okay, so if you get a payoff of $10 on an option, but you paid $2 for premium for it, so your profit is only $8, but the payoff is $10. Okay, all right. So let's look at. Okay, now make sure you understand this. Have you guys seen these diagrams before? Yes. When you did FM1, FM2, you did options. Did you see these diagrams? Yes. You have done them?
Yes.
No, some are saying yes, that means you have done it. Those who are saying no means they've forgotten. You've forgotten, right? So these are called, have you heard this term? These are called hockey stick diagrams. Okay? So what kind of hockey are they referring to? Ice hockey, not field hockey, right? So these are called hockey stick diagrams, right? So you should be aware of this. So if somebody asks you, are you aware of these hockey stick diagrams for options? Then don't say, oh, what is hockey stick? Okay, so be aware that these are called hockey stick diagrams. Okay, so please make sure you understand this. Look at this picture and look at the profit from buying an option call, a European call option. Okay, the strike price is 100. Okay, and they are plotting the profit. Okay, look at the profit here. Just make sure that you understand this. So the strike price is 100. You have bought from buying a European call. Okay, please tell me if I'm going too slowly. If all of you guys have understood this already, then we don't need to cover this. Do I need to cover it?
Yes, sir.
Yes? Okay. All right. So just understand why this chart is like this. Okay. So on this here you have the profit and then you have the stock price. This is we are talking about European options. So these are actually expiration diagrams. Another thing you have to understand about hockey stick diagrams is these are expiration diagrams usually. Okay, the hockey stick shape comes in during expiration. Okay, so we are talking about different scenarios. How do we construct this chart? This line is basically just constructed by joining dots. And how do we put up each of these dots? How do we plot each of the dots? Okay, let's take one dot. Let's take 90. So these are expiration diagrams. So understand that these are expiration diagrams, which means we are talking about scenarios where I bought a 100 strike call. Okay, I paid $5, and then at expiration, The stock price is 70, 80, 90, 100, 110, etc., etc. So I consider all these scenarios and I see what is my profit, and then I plot the profit against that. Okay? Okay? It's just like any other XY graph. Alright, so when the stock price is 90, I bought a 100 strike call. Will I exercise the call? Ritesh? I bought a 100 strike call and the stock price at expiration is 90. So will I exercise the call? 1 minute, let them answer. No? Why not?
Because it is higher. Because it is higher.
What is higher? What is 8?
So the strike price.
Strike price is higher than what? 1 minute, guys, please be quiet when I'm asking questions. Yes?
And the expiration price.
Then the expiration price. Well, actually what you should be saying is market price at expiration. If the stock price, the strike price is higher than the market price of the underlying asset at expiration. So it is cheaper for me to buy the underlying asset at 90 in the market rather than exercising the option and buying it at 100. That's how you should be answering this kind of a question, because remember, you have to always answer questions for your own mental training. You have to answer it as if you are talking to a computer. Okay? You can't just give one way answer. Human beings may understand, but computers won't understand. If you train yourself to talk to a computer all the time when you're discussing business related matters, it will sharpen your thinking. Okay? Alright, so when the stock price, so 90 is clear to everybody, so I don't exercise the option. So what is my profit then? What is my PNL? Let me not say profit. What is PNL, you understand? What is my PNL? Huh? Premium. Who said premium? No, I'm asking you, what is my PNL? Like if I buy dollar Swiss at 99.70, $1 million Swiss, and I cut my loss at 99, what is my PNL? It will be some loss number. Okay. So in this same way, I'm asking you, if I bought this 100 strike call and the market price at expiration is at 90, and then I paid $5 premium for it. So what is my PNL at expiration? Sorry? 15 loss. Okay. Anybody else? Any other loss number? Like bingo, we can go around and have loss numbers. Anybody, any else? Shreya, what is the number? 15 loss?
No.
5 loss. Okay, is this clear? Okay. So 1 minute. Now Gulati and Anjum, we have to deduct marks again. They are becoming very active as a group. Again, you are discussing.
Sir, जो आप बात कर रहे थे, question से पूछ रहा था मैं.
No. I don't know what you're doing. Then you come somewhere else. You come and sit next to Mehak. Come across since you're on the outside. Come, don't.
Sir, in this case, the premium.
First, let me increase their premium. 1 minute.
Sir, question नहीं तो पूछ रहा था मैं.
1 minute. To the power 2. 1 minute. I can't even see the caret sign. To the power 2. Okay. Gulati, come and sit. Someone sit next to Mehak. What is the time? No, 1 minute. You come. Don't lose more marks for yourself. Come and sit here. Here there are already 2 people sitting. No, he is tall, so I have to make him sit somewhere in the back because I can't seat him in front. Then people won't. Come and sit next to Mehak. But don't disturb her. Don't distract her. No, you sit there. You don't create further problems. Come and sit next to Mehak. That way you don't lose more points. Okay, this all these is no, not there. Next to her. What problem does she have? Okay, fine. You just make sure that you can see everything, because here you might have a sight problem. 1 minute. Okay. All right. So we are discussing payoff. Right. So is everyone clear? In the case where the option price at expiration is 90, what is the loss, Shreya?
So according to me, it should be 15 because the market price is it's at 90 and the strike price is 100 and we are keeping paying $5 premium. So that would be 10%.
Okay, $5. So why the 10?
So because market price is 90.
Because Garvit is saying the loss should be 5. Others are also saying, some of them are saying now 5. So why the 10?
No, sir, I am saying it's 15.
Yeah, so your 15 is made up of a 5 and a 10.
Yes.
So why the 10?
So because the market price is 90.
And exercise price is 100. But what is the first question I asked Ritesh? That when the market price is at 90 and you bought a European call with a strike of 100, at expiration the market price is 90, will you exercise the call? And what did Ritesh say? No. So if you don't exercise the call, that means you're not, what your 10 is coming from a visualization that you exercise the call, buy the underlying asset at 100 and then sell it in the market at 90 and incur a $10 loss. But that you're not going to do, right? Because you're rational, right? So that's why the loss is 5. Is everyone clear? Okay.
So
Please.
the loss is equal to premium.
Loss is equal to premium,
That
right?
I said in the first.
Okay, I don't remember the context in which you said premium. Okay, maybe I'm not disputing that. It didn't seem to make sense to me at that time. Okay, okay. Now one more thing you guys have to note is this is a expiration diagram. Okay, so now strictly speaking, we ignore. What are we ignoring if we are showing? Let's say they have not given you the tenor of the option here. They have not given you the tenor of the option. Let's say this is a 5-year option. Okay, and let's say you bought thousands of contracts. Okay, and we are talking about the profit or loss per contract, or let's say. So if you bought, let's say in this case, what is the thing that they're not showing you? If they're showing at 90, they're showing it as -5. So, and these are expiration diagrams. So remember, the premium is paid up front. Okay, so the other thing to remember about hockey stick diagrams, so a few things. Hockey stick diagrams show, typically when we say hockey stick, we are referring to the profit profiles, not the payoff profiles, but even the payoff profiles will look like hockey stick. So you can take hockey sticks diagrams as referring to both payoff and profit. Okay, profit is payoff adjusted by premium. Now, these are expiration diagrams. First of all, be clear that these are expiration diagrams. So they are scenario analysis. Basically, you plot it by doing a scenario analysis at expiration for different stock prices, for different underlying asset prices. Don't say stock prices because we need to use general terms. Okay. So the other thing that they do is, these are expiration diagrams, they ignore the time value of money. So strictly speaking, your loss is the $5 premium, but the $5 premium had to be funded. So in finance, I think I've told you guys that when you're buying something, you borrow and you buy it and put it on investment. Okay, but when you're buying something, the other aspect is that you are always going to assume that you have borrowed the money to buy that asset. Okay, so therefore you have to look at the funding cost of the premium also when you're actually working in trading rooms and pricing different instruments, okay, like futures or forwards or options. You have to be very clear about the funding cost. So whenever you're putting up premium at the beginning, remember, premium is paid up front. Okay, premium is paid up front, and these are expiration diagrams. So in these diagrams, we ignore the time value of money. But strictly speaking, your loss is actually 5 multiplied by the 1 plus I factor for that period. Okay, whatever the period of the option is. So you have to look at the funding cost of the premium also. So strictly speaking, a loss is the premium initial outlay plus the funding cost of the premium, the interest cost on the money borrowed to pay the money for the premium. To pay for the premium. Is this clear? Okay, another thing should be clear to you, that this is the expiration, and these we normally include the time value of money. Okay, so call option. Now one more scenario quickly, let's do. So when the price is 120 at expiration, what do we do? First question we have to ask is, yes, Golati, when the price is 120 at expiration and we have bought $100 strike call, what do we do? Do we exercise the call or not?
Yes, sir.
We exercise it. And what is the profit on the exercise? 20. Okay, and what is our net profit? Well, actually the payoff is 20. In this case, we'll say the payoff is 20 and profit is 15. Okay, we have paid 5. Okay, ignoring the time value of money. So you will go from here and you will plot a 15 here. As you can see, this is kindly around 15. Can you see that? Okay, all right. So this is how this chart is created. Okay, so if you ever get lost, you create it like this from first principles. This is what you should know. You should not memorize stuff and just remember that, okay, this one looks like this and this one looks like that. You should be able to construct everything from the basic steps, through the basic steps from first principles. Okay, call option payoff profile, it looks like this, and over time as you play with this, okay, you have to remember, you have to keep on tinkering with it and playing with it until you become fluent in it. Okay, that is your comfort level, whatever amount of time it takes you to become fluent in it. Your job is to become fluent in it. Okay, so as you keep on doing it, then eventually it will just become second nature, because the moment you see it, you'll recognize it. Okay, all right. So call options, all this stuff you have to read. Okay, make sure you read everything and understand. Okay, what is this? Put option. Okay. Profit from buying a European put option. Okay, let's see. So strike price is 70. Okay, let's say at expiration the price is $50. Okay, so if at expiration the price is $50, okay, and you have bought a 70 put, so what is happening? Are we making money, or yes, Anjum? If I bought a 70 put and at expiration the price is $50, what did I say, $50? I bought a 70 put. Okay, so this is how we speak in options. We say that, we just say the strike is 70, then we say I bought a 70 put. That means the strike is 70. So I bought a 70 put, and when at the expiration the strike the underlying asset price is $50. So am I going to exercise my put or no? No. One minute. Only Anjum should answer. One sec. Yes, I'm going to exercise the put. Why? Explain logically, stepwise, just like I answered Ritesh. I was coaching Ritesh how to answer. Explain to me logically, stepwise. I'm a computer, I don't know anything. Explain to me why I should exercise a 70 put when the underlying asset price at expiration is $50. Is my question clear?
Yes, sir.
Your answer is correct, but you have to explain to me why it's correct, as if I'm a computer. Yes, okay, Tanya, let's give her the mic. Give her the mic. Yeah, tell me stepwise, why should I exercise the 70 put? Yeah.
Sir, because the share price is 50 and we have a put option of selling the shares at 70. So we'll be making a profit of 20, but here the premium is given upfront, so we will adjust that premium.
Okay, so actually one more thing which you should have said, which a computer will not know, that is the put option gives you the right to sell the underlying asset at the designated strike price. Okay, so by holding a 70 put, I hold the right to sell the underlying asset at 70. So when the underlying asset is at 50 at expiration, by selling it at 70, by exercising the put, and then further buying it back in the market at 50, because remember that's how you close the profit loop, right? You should not have any positions left. Okay, you should be square. So I can make a clean profit of $20. Okay, that is how you should answer it. Okay, therefore I should exercise the option. Okay, is this clear? What happened, Gulati? What is the problem?
Sir, he is asking questions from me.
He's asking question to me.
Sir, it will be a profit of 20 or 30? 20.
No, sorry, the payoff is 20. Correct. You're correct. So correct to point out. The payoff is 20. Okay, and the profit will be 13 because there is a $7 premium amount that you've paid. Okay. Now let's look at another example. Okay, 70, which is not obviously is there. Okay. Let's say the price is 68. Okay,
Yes,
68. If the price is 68, I'm holding a 70 put. Yes. Now, Srishti, what should I do? Should I exercise? No. Yes, no, or you don't know?
No, sir.
No. Why not? I'm holding a 70 put. The put option gives me a right to sell. Always practice answering questions like this. This is again not just for this answer, but it will train you to answer every question like this. Always train yourself to answer questions as if you're talking to a computer. That will make all the stepwise logic very clear in your head, because the computer doesn't know anything. The put option gives me the right to sell the underlying asset at 70 at the strike price of 70. Now I hold the 70 put. The underlying asset price at expiration is 68. Now should I exercise my option or not? 1 minute. Srishti will answer first. 1 minute. Then we'll go to Bharat, or where's the mic? We'll go to Arjun because the mic is nearer to her. But let Srishti answer. Is my question clear? I'm holding the 70 put, underlying asset at expiration is 68. Should I exercise or not? And I paid $7 premium upfront for the option. Should I exercise or not? What? No or yes?
No.
I should not exercise. Okay, good. So now next, Anjum, what is your answer? You also know. Okay. And then Sakshi. Oh, let's go to Sakshi again. We go by the mic theory. The proximity to the mic. Yes. 1 minute. Be quiet when one person is answering.
So we will exercise the option.
Okay. Why?
So because
Parul is also nodding aggressively. No, she doesn't want to. Tanva also doesn't want to. You're all alone. Gulati, do you want to exercise or no?
No.
I know. I mean, we are not talking about MMA exercise. We want exercise, option exercise. Yes. You also don't want to exercise. Okay.
so if the share price is 68,
Bharat is 1 minute. So Bharat, you want to exercise? You want to exercise? You also don't want to exercise. Okay. Yes. Okay. Now let's see. Only one person wants to exercise the option. Okay. Yes. Let's listen to her answer.
if the share price is 68 and the strike price is 70, then 2 rupees we are saving here.
$2.
$2.
Yeah.
So $2 and minus.
Don't say I'm saving. Say that my payoff is $2.
And $7 premium, so it will be -5. And if I won't exercise the option, it will be -7.
Correct.
So
Very good. So this is how the question should be answered, right? So you should, because remember the concept of sunk cost. You have done the sunk cost concept, okay, in your projects and all that. Yes. Now we'll come. First, let's give the answer clearly first. So, she has given a very good way of answering. She has answered it very correctly. She's compared the two scenarios: either exercise or don't exercise. And if you don't exercise, you lose more money than if you exercise.
But sir, the price is
1 minute. Is this clear first? Okay. Now we come to the problems with the disagreement. Okay. Give them the mic. Give them the mic. 1 minute.
It's all the expiration date.
No, 1 minute. This question is not acceptable because I have already made it clear. These are expiration diagrams. Okay. So I normally never say question is not acceptable, but if we are talking about dogs, then again you're asking, is this a dog? So this doesn't make sense. Okay. So these are expiration diagrams. Okay. Yes.
And then she is right.
Then she is not. So, but this was always obvious. These are expiration diagrams. What was I saying? When I repeated the question multiple times, I said the option strike. I'm holding the 70 put. The underlying asset price at expiration is $68. I said at expiration. These are expiration diagrams. This is clear. I don't want to discourage people from asking questions, but the questions have to already factor in the information that has been given. Okay. All right. Yes. Everyone is clear. So therefore, you compare the two scenarios, whether you are and see where you make more profit. Okay, and you choose that course of action. Is everyone clear? Khushbu, you're clear? Okay. So now, there even at 68 we are exercising. Now, what is the profit? Payoff at 68 is $2, and the profit is $5. Loss is P&L is -5. Okay, so you will see that if you look at 68, if you drop vertical from here, it will be around -5. Can you see that? If you drop there and then draw parallel, it will be around -5. Yes. What happened? Hardik is very amused. No, I'm just making sure that everybody understands how. I just like to point out through all the basic steps so that nobody is, because anyway you guys are not very focused on understanding everything step by step. No, you're skipping through the steps. That's not good. So I want to make sure everybody understands all the steps. Okay, that's why I'm doing it through baby steps. Okay, all right. Okay, now what is this? Remember, writing means. What does writing options means? We also use the word option writer. Option writer refers to buyer or seller? Seller. Okay, so we also talk about option writers. Okay, it's just like you write an insurance policy. So remember that in insurance contracts, the insurance is written by the contract is written by the insurance company. Okay, so that's why, if you remember, we had discussed a principle. Let's test your memory for lab from your legal aspects course. You remember the expression called contra pro parentum? Contra pro parentum was discussed in which particular case? Guilford Motors versus Horn, I think. Oh no, it was discussed in Carlyle versus Carbolic Smoke Ball, or yeah, I think it was discussed in Carlyle versus Carbolic Smoke Ball. No, I discussed it. I'm very clear. I discussed it. What does contra proferentum mean? 1 minute. We also had this concept. Contra proferentum will be important even for people who are going into HR roles, because those of you who are going into HR roles, when you design employment contracts like yours, okay, employment contracts, if you remember, Gulati was asking about the fire insurance case of a fire in a factory which is not covered, okay. So I gave that example also, where if contra proferentum means interpretation against the draftsman. So who has drafted the contract? The insurance company, okay. So if there is any dispute, if there is any ambiguity, the first condition is there must be ambiguity. If it's very clear, then there's no room for contra proferentum. But if there is a dispute about a contract and there is an ambiguity in the clause, in the interpretation of the clause is not clear, okay, the words are not clear, then it will be interpreted against the party who has written the contract, who has drafted the contract. So in an insurance contract, if there is any ambiguity, like we said, I gave the example of that fire insurance case of Gulati where you had some fire in the factory. If it's not clear that the factory is covered or not, then it will be interpreted against the insurance company, so the factory will be deemed to be covered. Okay, so remember all these things. So always jump around between disciplines, okay, don't just get caught in finance. So you'll see legal aspects coming into play everywhere. So the insurance company writes the contract, so there's a dispute, ambiguous clauses, they will be interpreted by the court against the insurance company, okay. The same principle came up in Carlyle versus Carbolic Smoke Ball, because the Carbolic Smoke Ball company wrote the contract, okay. So the ambiguities would have been interpreted against them, but that principle was not applied, but it was discussed. Okay, they didn't even mention contra proferentum, but I mentioned it because that is what the principle is called. You should remember it when you're doing employment contracts. Employment contracts, drafting of employment contracts, there should not be any ambiguous clauses, right? Okay, so what is this now? Option writer. This is the payoff profile for what? Selling of what option? Short call. So you should revise these things. You should be so familiar with these things that you can just recognize it like that immediately, okay. So short call, let's look at this, if this chart makes sense, if it is properly drawn. So I sold a call at $100, okay, and the expiration at the contract at expiration is, and the underlying asset price at expiration is, I'm just going to call it stock price because stock is a shorter word. But remember, when general principles, when you discuss, you should talk about underlying asset, don't just say stock, okay. Sometimes I've seen in the IPM exam paper, we are discussing a currency example, dollar Swiss, and people are answering saying stock is at stock price is so and so. Where did the stock price come from? Okay, so anyway, so you could have either written underlying asset price, or you should have written the currency exchange rate, or the currency is worth so much. Okay, so be careful, don't just use, because everywhere we are trained to talk about stock markets. No, people come to me always and say, I want to learn about stock market. So but we have to talk about general principles, okay. So okay, so I sold at 100 call, and at expiration the underlying asset price, stock price is 130. So is the buyer of the option going to exercise? No, the buyer of the option. I am what? I am the seller. I am the option writer, so I am the seller now, okay. So I am going to exercise. Yes, Puneet, is my question clear? I am the seller of the option. At expiration price is 130. I sold 100 call. Is the buyer going to exercise at expiration? Yes? Okay. Why? Again, give me a stepwise logical answer. Use the mic. Give him the mic. Where's the mic? Give me a stepwise logical answer. Why will the buyer answer? Why will the buyer exercise the option? Yes. What happened?
Because exercise price is more.
Exercise price is more. What is the exercise price?
130.
Exercise price is not 130. Strike price is the same as exercise price. Exercise price is 100. So you have to be careful about what you're saying. No? The other thing that you have to notice all the time for everybody is when you speak, a part of your brain has to be monitoring what you're saying. Okay, so because we are not perfect creatures, so everybody will make mistakes when you say something, but you should be able to monitor what you're saying and then make a correction that, okay, sorry, I said exercise price, but what I meant was market price. This is okay, but to be just saying market price, the exercise price is higher, and then don't even know, you're not even aware that you made a mistake, that's not acceptable. Mistakes will be made, but you should immediately correct it by saying, because a part of your brain is monitoring what you're saying. Yeah, okay. So the strike price, the market price is higher than the strike price. So why does it lead to the conclusion that the buyer of the option will, the buyer of the call will exercise the option? I want a stepwise logical answer. No? Pass Bonvita quiz contest. Pass it to Gulati. 15 seconds or something you get, right? Yeah. Yeah.
So since the market price is 100 and the expiration price is 130, the buyer will go for...
Again, you have flipped it around. Market price is 130. Exercise price is, I don't know if you said expiration price, but the
expiration price.
No, the market price and expiration price, there's no, then they're both referring to the same thing. The strike, you have to use the word strike price and market price at expiration. Option strike and option market price at expiration.
So the option strike price is 100 and the market price at expiration is 130.
Yeah.
For the buyer, it is showing that he will be getting a payoff of $30 and a net profit of $25.
Okay.
So he will exercise this option.
Okay. So the other part again which you failed to mention is that the call option gives the buyer the right to buy the underlying asset at the strike price. Because remember, you're talking to a computer. You're not talking to me or somebody else who knows all these calls and puts. You have to put yourself into that particular frame of mind. Okay. So is this clear now? Call option gives you the right to buy the underlying asset at the strike price. And here the scenario is such that if you exercise the call, you will buy the underlying asset at 100 and immediately sell it in the market at 30. That gives you a $30 payoff. Okay, and so whenever you have a positive payoff, you will the rule is basically that when there's a positive payoff, you will exercise it, because it allows you to reduce, even in the worst case, if the payoff is not greater than the premium that you paid, it allows you to reduce the loss on the premium. This is clear? So whenever there's a positive payoff, you will buy the option, you will exercise the option. Okay, this is clear? Srishti, are you following? This is clear? Okay. Now, short put. Okay, this is a short put profile. So if I bought a 70, if I wrote a 70 put, and the expiration price, market price at expiration is say 90, then will the buyer exercise the option? Hardik? I wrote a 70 put and at expiration the market price is 90. Will the buyer exercise the option? Yes. What will the buyer do? The buyer is holding a 70 put. What does that give him the right to do? No, let him answer. What does that give him? The mic also.
That gives him the right to sell the underlying assets. At market price.
Market price.
At strike price.
At the strike price. What is the strike price?
The 70.
70. And what is the market price? 90. Okay. So if he exercises the option and sells the underlying asset at 70, then is he showing a mark to market? What is the payoff? Is it positive, negative? What is it? 1 minute. Let Hardik answer. 1 minute. Is my question clear? Hold the mic. Hold the mic like, imagine you're a baby sucking your thumb. You know, put the mic close because most of your voices are not coming through the mic. Yes. Hold the mic properly so that the mic is coming through the voice is coming through the mic. Yes.
So the last question was not clear.
One minute. You have 1 minute. You have sold a 70 what is this, 70 put? You have sold a 70 put. The market price at expiration is 90. Okay, so you're saying that the buyer of the put is going to exercise the put. The put gives him the right to sell the underlying asset at the exercise price, strike price.
Yes, sir.
So that means it gives him the right to sell the underlying asset at 70. Yeah, 1 minute, be quiet. Be quiet when we are explaining something, okay. Yes, it gives him the right to sell at 70, the strike price. What?
Sir, it gives him the right to.
It's a put. I sold a put. I am the seller. I'm now talking about the buyer. I'm imagining the buyer's incentives. Okay, everything is incentives. Okay, so I sold a 70 put. That means I've given the buyer the right to sell the underlying asset at 70. At expiration, the market price is 90. You're saying the buyer will exercise the put option and sell the underlying asset at 70.
No, sir, he'll buy the underlying asset at 70.
You cannot buy the underlying
No, sir.
asset. See, the put option does not give you the right to buy. If you want to buy the underlying asset, you'll have to buy it in the market. Okay? And what is the market price? 90. So if you want to buy, you'll have to buy it at the market price. You can't use it. You can't use a put option to buy the option, to buy the underlying asset. Yes. So you'll buy it at 90. What? You just said it.
No, sir.
1 minute. 1 minute. 1 minute. What happens? Srishti is getting bored. You want to help him with the answer? You want to help him with the answer? Let him figure it out. 1 second. Are you following what you're saying? I am only repeating what you're saying. I am only holding you to your statements. You said that the buyer will exercise the put option. So I am now you can't change from there. You're locked into that statement. Okay, the buyer will exercise the put option means the buyer will sell the underlying asset at 70. Now you want to buy the underlying. If you want to buy, you can't buy by using a put option.
I'll not buy that.
You will not buy. You will only sell the underlying asset at 70. But then you have a position, you are short at 70. What is your mark to market P&L? If you are short, 1 minute. 1 minute, don't answer. I want him to answer. You have sold the underlying asset at 70. What's your mark to market P&L right now?
Sir, loss of 27.
Loss of 27. Okay, good. So why did you exercise? If you had not exercised, what would have been your loss?
Only 7.
Only 7. So why did you exercise? You want to lose money. I want to do all my trading with Hardik. Yes, as the counterparty.
He works in RBI.
He works in RBI. Okay. Okay. So now have you understood
Yes, sir.
that you should not exercise? Is everyone clear?
Yes.
Srishti, you have followed? Okay. You should not exercise. So the basic logic is you look at but don't mechanically just look at the payoff. I think you should, for your stages, at your stage when you are new to the subject, okay, I think you should go stepwise like this. That put option, I am a seller, I am the writer, I am a seller. This is the profile for the option writer, okay. Short put, this is a short put profit profile, okay. So therefore, when you want to plot the values to construct this chart, you have to assume that what is the buyer going to do? Because I am a seller. What is the buyer going to do? Is he going to exercise or not? So you have to look at, what has he bought? He has bought a put option. That gives him the right to sell. Okay. Then you see that the market price is 90 and the strike is 70. So why will someone sell at 70 by exercising the put option when he can sell in the market at 90? Okay, so therefore he will not exercise. Okay, and in fact you can just look at it that if he sells by exercising the put option, he'll have a mark to market loss of $20. Okay, so immediately has a negative payoff. And you look at this, the best way to do it is the way she has suggested. 2 scenarios. If you don't exercise, what's your P&L? And if you exercise, what's your P&L? Is this clear? Right?
Sir, if you don't exercise, we will have a P&L of 30. We are keeping it and market price is 90 for that option.
No. 1 minute. Now we are not talking about the seller's P&L. We are talking about the short put P&L. Okay. So that's why what you see when the option price is 90, what does it show here? The P&L, the profit.
There is only 7.
-7? Who said -7? Who said -7? Somebody said -7. Shuchi said -7. Okay. So minus for Shuchi. Okay. So yes. Now you're saying the P&L plot is not correct. Again doing baby steps. Okay. Against when the underlying asset price is 90. What is my P&L plot? Because I'm plotting profit for given values of the underlying asset price. When the underlying asset price is 90, this chart is showing me a profit plot of +7. Okay, you're saying it should be 13. Why? +13, -13, what? +13. Why should it be 13?
Sir, there is premium of 5.
Premium is 7.
Premium of 7, and you are saying that market price of the option right now.
No, I didn't say market price of the option.
Market price.
Terminal stock price. See, these are put options on stock. Okay, so the underlying asset here is the stock. Okay, so now you're clear. Okay, so that you can see now. Therefore, you have to. These are all little tricky because these are new concepts for you. You might have done it in FM1, but you must have forgotten. Okay, but so it's new again for you. But these are all very basic things. But you have to get at least your basics clear. Okay, don't try to build an Empire State Building before you can build one. At least construct a stool or something like that first. Okay, make sure your fundamentals are clear and you revise it multiple times until you can just do it like that. Okay, make sure you're thinking the logic is very clear. Okay, so here, because here you're talking about a short put profile, if the option doesn't get exercised, you will be basically pocketing the premium. This is what is happening with, let's say, maybe almost 80% or 90% of the policies that insurance companies are selling. If you sell a whole bunch of life insurance policies and people start living forever, basically you just pocket everything, right? We all become immortal, then they just pocket the premium. All right, so is this clear now? Okay, so when you sell the option and you just pocket the premium if it doesn't get exercised. Okay, now we are looking at payoffs. What happened? Already Garvit is getting restless. You have a question? You have a question? Yes.
I wanted to ask that while we are trading in the software, so we can't exercise. So basically, sir, how will we be able to earn basically?
Well, you can sell the option.
We can sell the option, but we can't exercise, right?
Yeah, so I put a ban on exercising the option. In any case, most of the time exercising does not make sense because remember we did intrinsic value versus time value. Total option value is equal to intrinsic value plus time value. Remember that? It's there in your notes somewhere. Okay? If you go further up, you'll see. Okay? What is this? Alright? But you remember that? 1 minute. Be clear about that. You remember option premium is equal to, go back and look at the charts. In your notes itself, I put that chart from the from one of the websites. Okay, I think Options Education or something like that. It's an official website of the OCC, Options Clearing Corporation. All right. So option premium is equal to intrinsic value plus time value. Right. We don't have time to. We are talking about time value. We don't have time. But if we remember, if you look at your option premia, okay, and you look at the strikes, remember what is intrinsic value? No, you've forgotten what intrinsic value is. No, Parul. What is intrinsic value? Mike. What happened? You remember what intrinsic value is? No? You don't? No, you are just reading from the notes. This is not acceptable. It should be clear in your head. Why do you have to refer to the notes? This is very simple stuff. By this time, it should be in your head. 1 minute, be quiet.
Intrinsic price is underlying price.
Not intrinsic price, intrinsic value.
Is underlying price minus strike price.
Don't always, that statement may not be true for all kinds of options. You have to give it in a general English language kind of statement. Intrinsic value is basically, think of it conceptually. Intrinsic value is the profit, if any. Loss is not counted. We don't say intrinsic value is negative. Okay? So if the profit, or another way to remember it is what is what they've written in that website, that intrinsic value exists only for in the money options. Okay? So intrinsic value is basically, the better way to think about it is, if you can make any positive profit, zero or negative is not, zero is fine, but negative intrinsic value we don't mention. Okay? So if you can make any profit depending on whether it's a call or a put, and where is the exercise price and where is the underlying price. Can you, if you could immediately exercise the option, would you make a profit or not? Okay? Just imagine what the strike price is, whether it's a call or a put, and where is the underlying price. If you were to exercise the option, would you make a positive profit? If you have a positive profit, then that's the intrinsic value. And the total option value is equal to intrinsic value plus time value. Okay? So the reason that, Galvit is complaining that there are certain cases where, you can read about it in the textbook also, there are certain cases like non-dividend paying put options or non-dividend paying American style put options or non-dividend paying stock. Certain cases, rare cases where you make sense to exercise with very high interest rates and things like that. So, but in general, if you exercise the option, remember this rule, that if you exercise the option, all you're capturing is the intrinsic value. Is that correct? Yes? Because what am I doing? If I'm selling 100 call when the market is 90, if I'm exercising 100 put when the market is 90, I'm just capturing that 100 minus the 90. Okay? But that option will also have some, suppose that's a 3-month option, that will have some time value also. So that means if I capture only the $10, the option premium will typically be worth more than 10, it will be worth say maybe 12 or 13 or something.
Yes, sir.
So it is better for me to sell off the option, because that option price includes both the time value and the intrinsic value. Don't look outside. Okay? Is this clear?
Yes, sir.
Are you following? Yes. Remember this logic. Why does it not generally make sense to exercise the option? Because by exercising you capture only the intrinsic value. But the option price which is trading in the market, open your option trader here and see it. It will contain both time value and intrinsic value.
Yes, sir.
So why not just sell it in the market and get the extra time value benefit also? Yes, is this clear?
Yes.
Go back and revise this. How to think about intrinsic value. Don't read from the book. You have to. It has to be internally already in your head. You should be able to just go and stand there and talk about it. Clear? Any technical questions? Yes. Any technical questions? No technical questions. Oh, now it's all going for Diwali. Thank you.